Good evening. I'm Richard Kapsch again, Managing Director of Pride Holdings, LLC in Schaumburg, Illinois. And I'm talking to you today from Schaumburg. This evening, what we're going to cover is Introduction to Technical Analysis. But before we do that, I have just one administrative comment to make. Last week, we had trading in futures contracts, and apparently there was some problem with the sound. So as a result, most people didn't hear the presentation. So we're going to reschedule that session for May 10th or May 11th, about a month and a half from now, about a month from now. So we will continue that after the regular scheduled 8 sessions. So we had a session called Forecast Prices. And in it, we talked about fundamental analysis. And at the time, I mentioned that fundamental analysis was good for determining where a price should be at some date in the future. The problem with fundamental analysis, however, it points where rates should move, but it doesn't tell you when to put on a position, either a short or a long position, to take advantage of that move. And that's where technical analysis comes in. Technical analysis, I think, is the best for timing entry to and exit from the market. The key elements we're going to talk about today in technical analysis are endogenous. Technical analysis makes use of endogenous factors. Now, I use these two words, exogenous and endogenous, which probably none have ever heard of, but way back in graduate school on forecasting, and that's all the professor talked about was endogenous and exogenous factors. Exogenous comes from the Greek ex, is outside of, and that's where fundamental analysis comes in. Endogenous comes from the base endo, which means inside, and those are factors that can completely be found within the movement of the markets. So what we're looking for in technical analysis is we analyze endogenous factors, factors that are completely contained in the market movements. Now, the key thing in technical analysis is we want to use it to determine trends. If you remember, I said the last few weeks that if you want to be successful traders follow trends. They don't try and pick tops or bottoms, but rather they identify trends and ride those for as long as they can. And the key saying that goes with technical analysis and as far as successful trading in general is the trend is your friend. That means ride with the trend as long as you can.
Sorry to interrupt you, sir. I couldn't get you after the trending part. It's a good time to enter the market, or I missed it out.
All right. All right, let me go back. I guess I'm cutting out again, right? Can you hear me now?
Yes, sir, I can.
Okay.
From my side, it's the service is a bit intermittent. I'm not sure if it's on my side or what's happening, but you're cutting out a lot.
Where are you located?
I'm in South Africa.
Yeah, so and my side. So we'll try to do this as best as we can. We've been having bandwidth problems last week and this week, so we'll continue to try.
Okay.
Anyway, so why technical analysis is best for timing entry to and exit from the market. And as I said, the key elements involved in technical analysis are analyzing endogenous factors, factors that are contained within the price movement of whatever market we're trading. We're not really interested in any outside factors, such as supply and demand of a commodity, everything we need to look for in terms of technical analysis is right there within the market movement itself. Now, the important thing as far as technical analysis is concerned, with the way traders use technical analysis is to identify as long as they can. If their primary interest is not picking bottoms or tops, but simply riding the trend, that's where their money. And we go back to this, when you're looking at trends, remember that your friend don't. The other thing that we can get from technical analysis are support points and resistance levels. And you'll see in the tools we're using that we can find these and peaks and price levels. We'll all get through the tools we're using in technical analysis. Okay, is everybody with me? Did everybody understand that?
So I believe you said it about the key elements, about the support resistance. If you can repeat that point once again.
Okay, besides identifying trends on with analysis, we also look for support points and resistance levels. And we find that the tools we're going to talk about, we can look for trends in the price movement, peaks in price movement, and also various price levels that become significant as far as support and resistance is concerned. Everybody okay?
Yes, sir.
Yeah, under the circumstances, yeah, I think we're okay.
You're what?
I'm saying under the circumstances because the video, the audio is also still not clear in the video, but there and there I think we're getting it.
Well, we'll see what we can do.
Yeah, so what we'll say is, like, Albert, hi, this is Ruxana here. What we can do is, in between wherever we do not understand anything, we will interrupt, so that if you don't mind, if you can repeat it once again for us, so we are clear on that.
Repeat something now or go forward?
We go forward, sir. Correct, Albert?
Oh.
Yeah, I think we can go forward.
Yeah. Yeah.
No? Okay, thanks. Okay, let's look at some basic tools of technical analysis. And the most basic tool that we use in technical analysis is the bar chart. Bar chart is a very, I think, unique chart because now the entire price movement over a period of time. And the chart with one vertical bar, it could be a day, or it could be an hour, or it could be as little as a minute. And what that bar represents is the upper level of the bar, the upper end of the bar, the low of the movement within that time. And then there are ticks on the left side, the tick on the side opening was for that time. The tick on the right side tells you the closing price. And as I said, in the old days, to construct these charts by hand using massive piece of paper. Thank God for computers today. You can get a chart in a matter of a second for any time period you want. But what we're most interested in is using a bar chart for daily price movements. So as I said, the vertical line represents, the upper end of the vertical line represents the high in the movement that day. The bottom end of the line represents the low. The tick on the left is the opening price. The tick on the to the right on that line is the closing price. So everything is contained in that one little line. And bar charts are good because there's no saying in life that says a picture is worth 1,000 words. And simply by looking at a chart, you can pretty much tell where the market gets some idea of where it's going. Everybody got all that?
Yes,
The last thing
Rita?
that you said, the last thing that you said we could hear was basically the chart represents the market, and we get an idea where is the market moving. Correct?
Right. Like I said, it gives you a picture of where the market's been, and gives you an idea of where it might be going in the future. So it's the most important tool. And because it can price chart for any commodity, any instrument, and for any time period within a matter of seconds. And any trading system that you're using will have a complete set of technical tools on it. So you don't have to go back to the pencil and paper. Okay?
Yes, sir.
Of chart that is also useful in getting a picture where things have been less useful in terms of trading is the line chart. The line chart simply takes the closing price each day and connects it with the previous day's price, drawing a line between the two. So the line chart represents the closing price every day over the period covered by the chart. But as I said, I don't believe it's as useful as the bar chart. Okay, everything, sir? Okay, once we get the bar chart, what we're trying to do is look for trends within that price movement. And we do this by drawing trend lines on the chart. And again, you can do these on your computer. But in this case, what we have is an ascending trend in the Swiss franc. And the way we draw that trend line is we pick 2 or 3 bottoms and connect them with a line and then extend that line out in the future. And the way we would trade up this thing with ascending triangle, we would look for support wherever that trend line touches the market, and then buy accordingly once it hits that trend line. Now, if you see on the right of the trend line, we see that the market dropped below the trend line, and once it dropped below the trend line, that might be a good signal to sell the market. So we try to identify trends by drawing trend lines on the bar chart. Okay?
Okay, sir.
Okay.
It's not rocket science, so, but it's been, analysis has been around for about maybe 100 years. Originally invented by, or discovered or invented by a guy named Charles Dow, who is also the partner of Dow Jones. And he determined that you could identify trends by charting these markets and then drawing trend lines up and down. So it's technical analysis has been used for 100 years. There are some people out there that say, well, that's all mumbo jumbo, you know. What does it mean? But the fact that people have been using it for the last 100 years tells it must have some value. Okay, here we have an example of a descending trend. In an ascending trend, we connected a couple of lows and extended the line out. In this case, with a descending trend, where it looks like the market is going lower, we pick certain points and connect them with a diagonal trend line pointing downward. And in this case, what this tells you, the trend continues until the market breaks through that trend line, as it did in September of that particular year. So we've got an ascending trend and a descending trend. And we can further refine this by drawing something called channels on the chart line, on the bar chart. In this case, we've got a descending trend line on the connecting lows and another descending trend line connecting highs, with the idea being that the market would trade within that channel until it broke out either to the upside or the downside. The likelihood would be, sometime it would bounce off the lower trend line and then right through the upper line. So these ascending and descending trend lines and channels are all tools just to help us get a better idea of what kind of trend the market is in.
So I have a question.
Yes.
When we see this particular chart, which is of Japanese yen, which shows two descending line, how do we interpret this?
Well, we can take a look at the bar chart without drawing a trend line, and it looks like the market is headed lower. From August to October, the market generally moves in a lower direction. So what you might do is to the upper end of in September might be a point where there's going to be resistance. People are going to be willing to sell it there, so that's where you should be selling it as well. And then hopefully ride the trend further downward, which you could have done from September to October. And then this chart doesn't show what happened after October, but you had a period there for a month where you could have been, if you had sold Japanese yen, you would have made money in the market. Okay?
Okay.
Does that answer your question?
Not from my side, sir.
That's all right. Another tool to use with charts is something called moving average. And what we have here is a 3-day moving average. And the way that's computed is you take the 3 last trading days, the closing price of each day, add them together and divide by 3, and that gives you basically an average of what happened in the last 3 days, but it's also used as a potential forecast for what's going to happen this day. So what this does is kind of smooth out the bar chart and give you another picture of whether or not you're in a downtrend or an uptrend. Probably the 3-day average, it's a little bit close to the market, so it's hard to make decisions based on just the 3-day average, moving average alone. Here you have a 10-day moving average, and in the 10-day moving average, what happens is you can see how the market moves, how this 10-day moving average even smooths out the price movements more than the 3-day moving average did. In this case, what you might do is, at that point in September, in this case with the British pound, when the market moved above the moving average, would be considered as a particular point to buy the market. Now, the 10-day moving average, I have a fondness in my heart for the 10-day moving average because it was a moving average. I was first introduced to technical analysis after I got out of the military following college. My first job was as a salesman for IBM selling computers. This was one of my objectives.
I'm sorry, sir.
Was to
we
sell
couldn't get through.
You couldn't? Want me to start over?
Yes, sir.
What point?
One of the, just 2 minutes ago that you said it, you know.
Okay, would I talk about a fondness in my heart for the moving average?
Yes, sir.
Okay. It's kind of an old war story, but anyway, when I first military following college, I went to work for IBM as a salesman selling computers to businesses that did not have computers. So this was 1967, and obviously long before the PC was even invented, and certainly well before smartphones. But I sort of had an interest in the markets, and I used to read this publication called Barron's, which is put out by the Dow Jones Publishing Company on a weekly basis, financial publication. And I saw in the publication an advertisement for a company called Commodex, C-O-M-M-O-D-E-X. I thought, wow, that's a techie-sounding name, you know. Maybe they can use a computer, or maybe they're not using a computer, maybe they could use one. So I went to visit this particular company, and this is while I was in New York at the time. And when I went to visit this company, it was in an area of New York which is now called Soho, and anybody that's been to New York might be familiar with it. It's in the area south of Houston Street in New York, but it's got a bunch of million-dollar condos in there now. 50 years ago, however, it was the fruit and vegetable district of New York. And there was this row of office buildings that were 4 stories high that had been built around 1900 and had no elevators, and you had to climb up the stairs to get to whatever office it was. I found the address for Commodex, and they were on the 4th floor of one of these buildings. So I humped up the stairs, you know. It was the middle of summer. I was hot as hell, sweating, and finally got up to the office, and I went in to the office of Commodex, and it looked like something out of Charles Dickens. I don't know if anybody's ever read Charles Dickens, but he wrote books that covered the period in England following the Industrial Revolution, when conditions were extremely bad working. Well, the first office, the outer office I walked into, there was this old lady, must have been about 80, who was the secretary, and then there was an accountant, a younger guy that looked like Tim Cratchit, and wearing a green eye shade, and there were papers all over the place. I said, could you please tell me what the owner is? They pointed to another room, and I went into this room and met the owner. His name was Edward Gothelf, and he said to me, "What do you want?" And I said, "Well, I'm from IBM. I'd like to talk to you about buying a computer." At the time, the cheapest computer IBM had was one that you could rent for $3,000 a month. Like I said, 50 years ago. So he said, "What would I need a computer for?" I said, "Well, I see you make some kind of price forecasting here. Maybe the computer can make your life easier." He said, "Well, I'll tell you what my forecast is. Every day I take the last 10 days of worth of prices, add them up, divide by 10, and that's my forecast for the next day. The next day I drop the oldest, add a new price in, divide by 10, that's my forecast for the second day. Is there any way your computer can make that cheaper or easier?" I don't think so, not costed with benefit. And so I gave up on that sale at the time, never did sell them one. I did see that the company, I think, is still in business, but what it did was give me an introduction to it, the fact that there were enough people willing to subscribe to this guy's service just to get the 10-day moving average, that there had to be something behind this average. So anyway, that's the 10-day moving average. Everybody follow me so far? Okay, another variation of the moving average is the 30-day moving average. And you can see where the 30-day moving average smoothed out the price movements even more. And so the way somebody views this moving average would be at the point back in July where the pound broke through the 30-day moving average, might have been a significant sell point. And as long as it stayed below the moving average, you would stay short until it crossed the moving average again and then became a point to buy. So we have a sell in July and a buy point in the end of September that year. So all because of, all indicated by where the moving average crossed the daily day-to-day movement.
Richard, just one question.
Okay.
When you use the moving averages, and when do you where is your entry point? For instance, if you move back just to around the beginning of July, or is it beginning of July or end of June, you do have, I don't know if I should call it a fake out or what, but it did cross the moving average going down.
Well, okay. Well, one place to enter or exit the markets would be in July, where the pound dropped below 166, and where the day-to-day movement in the markets broke through the 30-day moving average. So that might be so buying at the market the day that it broke through might be a good place to sell. The same way buying would be buying when the average, when the day-to-day movement broke the moving average. And let me show you the next chart here. The next slide. Here we have the three moving averages all superimposed on each other. 3-day, a 10-day, and a 30-day moving average. In this case, the other way people would use the moving average as entry and exit points might be where the 10-day moving average, which is the one that's a little bit smoother, the one that helps the day-to-day movement, but the one that's in between the two. You can see when this crosses the 30-day moving average, people would take that as a perfect sell point. And the same way, if you go back down into the end of October, when this case we have the 10-day moving average moving back above the day moving average would be a buy point. So if sold at those points in July, where the 10-day moving average crossed the 30-day moving average, and then again in September or October, not September, in the middle of September to beginning of October, when the 10-day moving average moved to 30-day moving average, you could have had two nice trades for yourself. Okay? I don't know if that answers your question about,
yes, it does.
When to move. But look for points where the plus moving averages, and if you've got moving averages together, use those as potential indicators. Okay. Now, in addition to trend lines, the other thing you could use charts to look for are support and resistance levels. Now, this chart shows a horizontal line at 1.30 Swiss francs per dollar, $1.30 per Swiss franc. And, you know, by drawing that horizontal line, you can see that there's kind of a natural support level at that level in the markets. In May, it came down and briefly crossed through that line and then moved back up again. And you see it came back to the line, moved up again in July, August, and September, and then came down and tested that support level in October. So, you know, looking for some kind of natural support line might give you an indication when to enter and leave the markets. In this case, I might have put a buy in below 1.30, maybe like maybe 1.29, because, you know, a lot of people are all going to jump in about a specific support level, and you might want to be a little bit below them because people looking for stops will go down and take out the people buying at those particular levels. But anyway, looking at a chart, you can look for natural support levels, which might be price levels. Opposite, in this case in the euro, we have resistance up above the mark around 118. And you simply treat these points. So again, what you're looking for when you're using these charts, or you're looking for trends and you're also looking for support and resistance levels, and you can draw lines at these levels, and most times you can use those lines as a place to either enter or leave the market. In this case, had you been, let's say, long the euro going into May, you know, when it came up to that resistance level and bounced off it, that might give you a signal that maybe the trend is running out, and get out of that level and look for another trade at which you could have done at that point. Everybody so far with me?
Yes, sir.
Okay, here we have something called an ascending triangle, which might be even a little more significant than just a general trend line. In this particular case, what we have is an ascending trend from August to October, and coming up resistance at a level of 118. And what happens, that triangle narrows as you get toward the cusp of the triangle. The market tends to break out one way or another, and when it does break out, let's say if it moves above 118 from that level, that's probably more significant than just breaking out, more significant than finding a buy at a specific support level. Okay, now, as far as I'm concerned, when I look for using technical analysis, I'm satisfied with using the basic charts to look for support and resistance levels. But there are people that want to go one step forward or one step further and use something called an oscillator to help refine their buy and sell points on the thing. And here I'm going to go through some of the commonly used oscillators in the market here. This is the momentum oscillator, and you'll see the way these plotted on the chart. This is for the Japanese yen. At the top right, you've got a standard bar chart in the Japanese yen, and the lower part, you've got a red line that varies in minimal levels, kind of bouncing off the upper line, and moving up again. That's the moment indicator, which is calculated by V minus Vx, where V is the latest closing price and X is the price some number of days ago at your choosing, let's say 10 days ago. So what happens is, as that continues to increase, tends to tell you that the trend is going to continue, but as it gets up toward the...
we lost. V is the...
Start with V. Okay, momentum equals V minus Vx, where V is the latest closing price in any market. In this case, the Japanese yen. Vx is the closing price X days earlier, might be 10 days earlier. So the momentum is simply the difference between those two prices. And as that difference widens, the momentum indicator tends to go up toward the upper end of that channel, and as it narrows, it goes down toward the bottom end. So what people look for are spots when the market is up toward the upper end of the channel as a sell point, when it's at the lower end of the channel as a buy point.
Okay.
In this case, it looked like there was a buy point in early October, and if you compare that to the market, you were probably a little bit early in terms of buying the market, but so the momentum indicator to move up before the actual market, but it's still an indication where you might were into the market. Everybody up? Now, one of the momentum indicator is if the price carried the close to break through that channel and there's no upper limit on the channel, we find the oscillator. CCI, the commodity channel index, and that's
sorry to interrupt you, sir. Can you start with this slide again about this commodity channel index?
Okay. Okay. One of the with M, the momentum index. There's essentially no upper end, so it could keep going and going. So you could send, it goes done is oscillator into something, the channel index, the CCI, and that's simply the M index calculated on the last chart by the net 10-day period. Guarantees the market will move around the C line. You can see 0, on the right, and the two horizontal red lines. So what you might do in this case by using the drop red lines above it. Again, probably to be a little bit early and if you
sorry to interrupt.
If you stop, I'm sorry.
Yeah, the system is too bad now. Since you started with this commodity channel index, I doubt there's anyone who got anything because it's too intermittent. We're not getting anything.
Okay, can you hear me now? Can you hear me?
Yes.
Yeah.
Yes, we can. So, but in case, like what Albert said, yeah, from the time we started with commodity channel index, we didn't get much. So, if this interruption, continues, we have to again interrupt you, and you have to start again with this particular slide. I hope you don't mind.
All right, I'll probably the indicator is that there are no upper or lower limit go to 0 or minus. The upper limit could go well above, the difference. So the low indicator of M or indicator M
So we can start. If you don't mind, can you just start with commodity channel index all over again, sir?
Okay.
Thank you.
Hope it's not as boring as everybody else as it is to me right now. Doing it for the 4th time. Anyway, the problem with the momentum indicator, M, is that there's no upper and lower levels on the chart. No absolute levels up and down. So people vary this, and when I show, instead of going through with details on everything, I'm just going to show you charts of some of the other oscillators that people use. You got the commodity channel index, which is M, which we calculated on the last slide, divided by the mean deviation of the price movement over a certain period of time. Okay, everybody got that? C is simply 100 times V minus X. Another variation here's another example of divergent moving averages, which we talked about earlier. Simply, you look to buy when the shorter moving average, or sell when the shorter moving average drops below the longer moving average. In this case, we've got the 10-day and the 30-day, and buy when the shorter moving average moves above the longer moving average. This one is a very popular one among traders. It's a relative strength index. And the RSI is calculated as 1 minus 100 divided by 1 plus RS, where RS is calculated as the average of days with up closes and the average number of days with down closes. So it's a ratio. As you can see, that's fairly more defined, it has more defined limits in there. So, like I said, that's a popular index if you want to trade an oscillator. Then we have something called stochastics, which is simply tells you as prices increase, closing prices tend to be closer to the upper end of a trading range, a day's range, and as prices decrease, the closing prices tend to be closer to the lower end of the price range. So this is a calculation of that, where C, it's 100 times C minus 15, I'm sorry, C minus L5, where today's close minus a close 5 days ago, divided by the high 5 days ago and the low 5 days ago. And as I said, it produces the chart that we see at the bottom there. And again, in any of these oscillators, you look to use them in conjunction with the bar chart. You want to buy when it looks like the market is moving up and the oscillator is down toward the bottom of a range, and sell when it looks like the market is starting to move down and the oscillator is at the up point of a range. One good point to sell in this case would have been in early August that year. We could see the market was topping out. You obviously don't want to sell the first time it gets up to that limit, but if it holds that limit, then you want to sell at that point. Another variation is slow stochastic, which is simply a variation on the fast stochastic. So all these things that I've showed you, the oscillators, are all various attempts. Percent R is the British pound is today's close, subtract highest price of the period and divided by the total range of the period. So I say, depending which oscillator you use, I don't particularly advise using them exclusively, but some traders find out that they're helpful in terms of timing your entry and exit, entry into markets and exit from the markets. So any questions on oscillators in general? I mean, you can find any trading package, and you know, the best thing to do would be to, my own advice, the one that seems to be the most popular is the RSI. Low, it means relative strength low, it indicates a down market. When the relative strength is high, it indicates that we're toward an up market. And when it reaches those boundary lines, you know, you might look for points to sell or buy into the thing.
Okay.
Okay, the last thing I wanted to talk about today are Fibonacci numbers. Now, there are certain traders that feel the price pattern follow the patterns determined by Fibonacci numbers. Now, this is a number sequence that was discovered by the Italian mathematician Leonardo Fibonacci in the 13th century. So I think we're kind of grasping here in terms of trying to relate these to the market. But again, this is what some people feel that the market patterns indicate. And what a Fibonacci series is, you can see a series there: 1, 2, 3, 5, 8, 13, 21, 34, 55, where starting with the third number, each number is the sum of the two preceding numbers. So 1 and 2 equals 3, 2 and 3 equals 5, 3 and 5 equals 8, and so forth. And the one interesting thing about the Fibonacci numbers is the ratio, as you get into larger numbers, the ratio of any number to the next higher number approximates 0.618. And sometimes when you see a correction in the market, you'll see that, you know, the market will be going up and all of a sudden it'll turn down. And there are three levels that people look for: 0.33, 0.5, and 0.67 or 661. That as that market starts to correct, it moves down a ratio of either half or almost 2/3, in this case, the Fibonacci number, at which point you can probably look for the market to turn back up again. So if your fundamental analysis says that we may have a bull market here, and we see a correction in the market, it could correct as much as 0.618. And still not break the bull trend or anything. So this is just something to consider. I don't put much faith in Fibonacci numbers, however. Anyway, that's about all I wanted to cover as far as technical analysis. I think the important thing is use the charts and look for trends in the charts as support and resistance, and use them as timing and when to enter and exit in any particular market. Any questions on anything I covered here?
So I would like to have only one general question. Since we have gone through so many charts and oscillators, according to you, are the best three which anybody can have a look at and decide about this position?
Well, I think in the charts, obviously use the bar charts with trend lines. Look for trend lines. Those are what I think I consider this, because the chart gives you a picture of where the market's been right up to the latest day. The trend lines simply help you when you're looking for buy and sell points. As far as the oscillators are concerned, the one that seems to be most popular is the relative strength index, the RSI. But I don't particularly like to use those. I prefer to, use the charts and various trend lines in conjunction with the fundamental analysis we talked about 3 weeks ago. Okay?
All right, sir. That sounds fine.
Anything else? Anybody?
No, I think for today everything was a bit straightforward, though we didn't get a lot of information there and there, but I believe it was straightforward today.
Okay. All right, so next week we're going to talk about options, and the next 2 weeks we'll talk about options, basics on strategies and options with strategies. So hopefully, maybe between now and next week we can straighten out these sound problems. Okay? Thank you.
Yes, sir.